Our club has always been a forum for public figures, thought leaders, and decision makers to share their ideas. Here, we offer access to dynamic political, business, and public personalities.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon and welcome, everyone. My name is Joseph Lowe, President of Canadian Club Toronto, and I'm so delighted to welcome all of you. I would like to begin by acknowledging the Indigenous peoples of all the lands that we are on today. While we meet today on a virtual platform, let's take a moment to acknowledge the importance of the land, which we all call home. We do this, of course, to reaffirm our commitment and responsibility to improving relationships between nations and improving our own understanding of local Indigenous peoples and their cultures. We are grateful for the opportunity to be able to come together and to learn on this land. It's wonderful that you're all joining us for our first virtual event of the Canadian Club season. And thank you to our AV supplier, Van Valkenburg Communications, and livemeeting.ca for making our digital experience today possible. More than 70 countries and 1,200 companies have committed to net zero carbon goals. Yet many questions remain unanswered on how these targets will be achieved. So globally, we're seeing a lack of uniform standards, with Europe on one hand making climate disclosures mandatory, while the state of Texas is banning some ESG-minded firms. Today's panel will share their ideas on how companies can navigate net zero and the key strategies for ultimately achieving these goals. I'm personally very proud to share that the Canadian Club is doing its part with a recent partnership with Canada's Forest Trust, a leading ESG firm planting smart forests to take action on climate change with the power of nature. We're proud that this partnership will help offset the carbon footprint of our entire season at the Canadian Club of Toronto. Now, before we hear from today's panel, I want to review just a few housekeeping items. The click here to switch stream button helps if you find that your internet is slow. So while the video quality may fade a bit, the audio quality should remain very strong. And once you click the questions tab, you can enter your questions in the window and they'll be sent directly to our moderator. The request help button located in the bottom right corner of the page is there for technical support if you've got any other questions or need help. And now it's my pleasure to introduce to you our speakers of the day. Jonathan Hackett, Managing Director and Co-Head, Energy Transition Group, and Head of Sustainable Finance at BMO. Adam Heltzer, Managing Director, Head of ESG, Ares Management. And Laura Zizzo, Co-Founder and CEO, Manifest Climate. Today's discussion will be moderated by Andrea Mandel-Campbell, Operating Advisor for Vertu Capital and a fellow Canadian Club Director. And another tradition that our club maintains is a toast that we make, of course, to our country. So if you have a beverage close by, please join me in a toast to Canada. To Canada. And now I'm delighted to turn things over to our moderator, Andrea. Andrea, over to you.
Thank you so much, Joe. And thank you to all of you who are joining us here today. I hear we have a very big crowd on the line for what is a very timely and important topic. So thank you very much for joining us. We've really amassed what I think is an excellent panel with with people with some very deep expertise, but coming from different perspectives. So I thought maybe best if we start off with each one of our guests giving our audience a little bit of an explanation around how you came to this space, a little bit of an explanation around your role, and how you're driving the climate agenda forward within your organization. Jonathan, let's start with you.
Great. Thanks so much, Andrea. I have a bit of I guess everyone has a unique path from how they end up in this space, but I'll say my work really came from a drive within BMO to articulate our purpose. And as we were looking at our purpose to boldly grow the good in business and life, realizing that helping our clients achieve sustainability, but through products that actually accelerated that journey, was a very natural fit. It became one of our anchor commitments for that purpose launch. And it really created the team that I lead now. It created our sustainable finance practice, it created our impact investment fund, and it really drove the way in which we approached our net zero commitment, which is to be our client's lead partner in the transition to a low carbon economy. And that's what created our energy transition group, a belief that we needed to not just be arbiters, but we needed to be working with our clients to help them understand how this fits into their business, how it will actually allow them to succeed, and where there are revenue opportunities. The same way we think about this as a large commercial opportunity for the bank, a lot of our clients view the transition to net zero as a revenue opportunity and as a way to create new value in their business. And so that's really informed how we've created our team.
Great. Laura?
Hi. So I intentionally have been working on climate change my whole life. So I really became aware of this before I went to undergrad. So studied it, went to law school, said, how do I actually, it's going to be I was part of the Canadian Youth Delegation back in 2007. And we were talking about net zero by 2050. And I did the math, and I'm going to be 69 in 2050. So I said, this is my career. How are we going to work on it? So I ended up working on Bay Street at a major law firm doing environmental law, carbon trading. And that was the beginning. But I started the first law firm in Canada focused on climate change back in 2009. Realized I was actually a management consultant in 2015, and it was all about connecting the dots. Jonathan, exactly what you said. How can we inspire business leaders to know that it is their job to think about this? This is not something that the sustainability teams think about as we move through the biggest industrial transformation we have ever seen, quicker than we thought was ever possible. So that's why we've created Manifest Climate, which is a software as a service solution focused on climate risk planning and helping organizations move through the climate transformation. It's the culmination of the last 20 years of work, but our team's excited to help organizations move through the transformation.
Excellent. Adam, over to you.
This is great, Laura. You're like the Greta Thunberg of Canada. First of all, very honored to be with you all today. Thanks for the invitation. My first time with the Canadian Club, but clearly a very esteemed organization, and happy to be part of this conversation. It's funny, as a head of ESG, 10 years ago, I'd never even heard the term before. So I spent the first long stretch of my career in international development aid. Did a lot of work in developing countries, projects funded by the Canadian government, US government, British government, and so on, in all these developing countries, building out infrastructure, agriculture, and so on. And one of the key learnings after a long stretch in that field was, if you want interventions to stick, to be sustainable, you need to engage the private sector. I had been based in Washington, D.C. I moved north to New York City, where this mythic private sector lives. And I worked for the World Economic Forum for 2 years. And there I was the agribusiness client lead, for lack of a better word, which meant as Cargill, Syngenta, the big multinational agribusinesses, went to Davos to improve the state of the world, I'd be the person to guide them and connect them to nonprofit, public sector, and so on. Interesting experience. Learn about the world of influence, learn how to structure a meeting very well, but you're not really the one driving impact. You're sort of facilitating impact among other influential people. And that's when I first discovered ESG. There was a Swiss alternative asset manager named Partners Group that was looking for a responsible investment professional in 2015. I thought that was a really funny term, responsible investment professional. What about the other ones? But that's when I first learned about this exciting opportunity, which is that if you can figure out, in contrast to hanging out with all the do-gooders all the time, figure out how the system works, how investment flows work, how companies operate, and how they're influenced by their owners, you really could have more of a systemic impact on the economy. So I spent 5 years at Partners Group before joining Ares. And to wrap things up, this is an opportunity for us to act at scale. We have $340 billion more or less of assets under management. We're private markets only, which generally means you have a bit more visibility and influence over your investments than you would in the public markets. And I lead a team of about 15 people across our firm that's integrating ESG into private equity, infrastructure investments, real estate investments, and so on. And last point relevant to climate is that, we are a very widely diversified investment manager. And so climate is so clearly at the top of the topic agenda across the ESG menu for a lot of our different stakeholders, clients especially, shareholders. And so we are working hard on figuring out a coherent way to act on climate, even though, as we've seen previewed, it's quite complicated. That's it.
Thanks so much, Adam. All right, I'm going to now turn it over. Starting off with Jonathan. There was some big news, or I think for folks in the ESG and carbon world, some big news coming out in July when BMO actually acquired one of Canada's leading carbon measurement and offset firms based in Calgary, Radical. Thought this was a super interesting move on the part of the bank, and I'd love for you to walk our audience through the rationale behind this acquisition. I think you alluded to it a little bit in your intro about being a lead partner for your clients, but talk to us a little bit about what your clients are looking for and how you think this acquisition will help them navigate, particularly net zero.
Yeah, I'll actually build on something that Adam touched on, which is so much of what we're trying to do here is take real efforts that have existed for years, right? Voluntary carbon markets are not new. Regulated carbon markets are not new. Understanding there's a carbon footprint isn't new. What is new, I think, is the desire to accelerate that. And the best way that we know how to accelerate something is to take all of the financial tools, all of the things that we use to make the rest of the economy go really fast and be really safe for people to put their money into, relevant pieces of it and to participate and to actually invest in the projects that need to happen to drive the real things that happen around us, and bring all those tools to bear in the climate finance space, in the sustainable finance and the energy transition space. And to do that, you need to be smart. You need to actually have people that understand where the risks are, how they're being taken, and how to minimize that. And as we thought about our role, one of the great things that a bank can do is be a counterparty on trading, helping both the people that are producing these credits and the people that are consuming them to think about how they can plan, how they can build into financial forecasts, how they can actually understand the risks that they're taking, and do that in a way that is mitigated, do it in a way that is contained. I think one of the conversations we've had with CEOs that has shifted in the last few years has been around, I want to make a net zero commitment, or I want to make an offsetting commitment. But if I really sit back and I think about it, I don't know what that costs. I think everyone that's boosting and promoting and pushing for carbon markets, a really big part of it, has these charts that go up and to the right and say, well, if we think about the social cost of carbon or the expected abatement cost, at some point this has to be worth so much more. But if you're a CEO sitting there saying, I commit to offset all remaining emissions, I'm going to do it credibly, I'm going to reduce, I'm going to do all the things I can do, but whatever's left, whatever I can't handle, I'm going to buy credits to offset them. Well, if you tell me that the price is going up and to the right, I want a way to manage that risk. And so we want to create a set of tools, of solutions with, what I believe is a pretty high quality credit counterparty in the middle to help our clients do that. But we think it'll unlock financing for the companies that are creating solutions, for the people that are driving these new opportunities. Because when you look at the project financeability of some of these, carbon generation projects, the real issue is if you don't have somebody signing this in blood, taking the credits at the end of the day, if you don't have a fixed price that somebody's going to pay, and if you don't have a way of managing those risks, debt's not the right answer. And we need the answer to be debt. I know it's weird for a bank to be saying everyone needs debt with a view that that's a good thing. But if we rely on equity to be the only way to finance projects that are creating net positive benefits in climate, we're going to be waiting a long time. And to get to 2050 that we'd all enjoy, we really need to bring different parts of the capital stack into those transactions. We think having Radical really gives us an edge to be able to help our clients make those choices, to make our ability to make those choices in a way that's responsible more effective. And that's what has me really excited about the integration of that team.
And just to follow up on that, Jonathan, can you give us give our audience maybe just a straw man example of what this might look like?
Yeah, so the easiest version of this is, we as a bank have found ways to take carbon credits as collateral for a loan. But we can only do that today before the integration of Radical in a way that reflects where we have price certainty, right? Where you can say, well, there are a set of buyers for these regulated carbon credits that we know that we could move this if something went really bad in short order, and that we could recover our loan in that way, and we can give, therefore, a price that's commensurate with that security. If I think about taking carbon as collateral on a loan, that the first thing that you have to ask is, what do you mean? Carbon's not a thing. Depending on who you ask, it's 2 things, it's 37 things, it's 78 things with different vintages and forms within it. And so having a way in which you can aggregate people that might have a diverse portfolio, people that might have a set of projects that's not straightforward, that's not just a single regulated carbon credit in a well-traded market, and saying, how do I give you leverage? How do I give you support to grow your business faster, to take the flows that you're going to have, get you credit for it, and if at some point to be able to take that and help it be syndicated, that requires that level of expertise that we're really excited to be bringing on as part of that transaction.
Laura, over to you. I'd love to get your thoughts on offsets in general. And obviously there's a very complex, there's a lot of complexity involved here. And, there's a narrative around, whether offsets are part of getting to net zero or not. And I'd love to hear your thoughts on that.
Yeah, I'm glad BMO's moving in this direction, but it's marginal. Right? It has to be marginal about the transformation that we have to take writ large. And this is coming from someone who built their legal career on helping trade offsets, right? So I did a lot of early emissions reduction purchase agreements, a lot of these things, and it's important. And it was exciting at the time to see people getting new revenue streams associated with carbon reductions. We need to continue to have that, but we need to move to net zero. So that means offsets hopefully are marginal as we move towards that. But Jonathan, what you said was so true. Do the deep emissions reductions first, right? So we also have to look at that. And that's what these regulated requirements for climate-related financial disclosure are really asking for. How are you thinking about your place as a business in the transition? And how are you going to take advantage of the fact that we're moving $150 trillion over the next 3 decades, according to the Bank of America, to get to net zero? That's a huge risk for those that are exposed, but a huge opportunity for those that can be part of the solution. And it's not all about offsets. Offsets is a part of it, but I think it's such an interesting topic. We always go to that first. So what I really encourage our clients to do is think about this as a systemic risk and opportunity, thinking about where these levers are to pull as you can move towards net zero. And offsets are part of the solution, but they're not where our focus should be, in my opinion, at a strategic level. We need to think about full systemic change and how your company fits into that as we move towards net zero. And the other thing to say is, climate has 2 big aspects. And I know we're focused on net zero today, but there's physical risk. So a climate story is not complete if you're not thinking about both physical risk and transition risk. And I found early on in my career, if you started talking about physical risk first, the costs of reducing don't look so bad, right? So if you actually start saying, what is at stake here? We're seeing some of these events today around the world. If we actually understand the costs, it's a no-brainer to reduce our emissions and to be part of that transformation. So I think we have to think about them at the same time. That's what the TCFD and some of the regulated requirements are asking us to do. And I think talking just about transition in a silo, it becomes, a cost center versus a systemic transition discussion that we really need to have.
Laura, though, just to follow up on that, how do you speak to your clients when you're talking about that physical risk and thinking about how they're calculating that in? Because it's such an amorphous concept in a way. It's like you don't know when a weather event is going to happen. You don't know when the crop is going to. I mean, how do you speak to them about that?
Yeah, I think all we know is that the past is no longer a good predictor of the future, right? And we do have models, and there's a lot of times we take modeling into consideration in our decisions. For some reason, climate modeling seems scary, but it's the same, and it's pretty good science. So we know that there's a bunch of different futures that it looks like in 1.5 or 2 degree future. And we know that if we don't get to net zero, the models are going to look a lot worse So what I say to clients is plan for uncertainty, plan for the past not being a good predictor of the future, and then do some modeling and scenario analysis, which is part of what the TCFD is asking for you to do, which includes both the risks for transition, but also the risks if we see what the scientists are saying is very likely to come for the business. So it's about flooding most of the time in Canada. It's about water availability. It's about extreme weather events like we're seeing in Newfoundland right now. You have to think that stuff through. One of the let's put this down to an example for a real estate client. What happened to you during a flood? Expect that to happen more often. How are you going to plan for that? That's business risk management, right?
Okay, Adam, I'm moving it over to you. I want to talk a little bit about, we have, a broad array here of opportunities in terms of how we're managing this. But, I think one of the things we hear most from organizations is the challenge around the actual measurement and reporting of carbon. It's really not that easy, and we're really entering a new territory here. So talk to us a little bit about that, what that means for an organization like Aries, which operates across the world, has hundreds of portfolio companies, and you really have to manage for so many different realities.
Yeah, it's a conversation that we have almost on a daily basis, and we sort of alternate between a firm-wide view and a desire to have a firm-wide coherent narrative around net zero, and then down into the strategies. And when I say strategies, I mean asset classes: real estate equity, real estate debt, private credit, liquid credit, infrastructure, private equity, and so on. So you're right, it's a challenge, and we have a broad, diverse range of asset classes. So, that would be one thing. If we actually had a framework that could fit all those different things, we don't. The frameworks for real estate are at one level of maturity. They're not ripe. Private equity may be more so, but still not completely settled in terms of how you should actually measure carbon and set commitments. So we find ourselves, at the organic level, decentralized level, advancing along the same path and eyeballing key milestones that we can say, this is all linked together into a coherent strategy for all these different strategies together. So I'd say that's one big challenge, is the ripeness and the consistency of how you would think about both measurement and commitments. Even if the frameworks were ripe, however, we tend to invest in the middle market, mid-sized companies, and we actually have more like thousands of exposures, not hundreds. And so, these are companies that are at a certain stage of their maturity curve. They're not startups and bootstrapping, but they are not public companies with tons of resources and tons of overhead. And so we invest in these companies because they are growing at a nice clip. We expect them to double their EBITDA in 3 to 5 years, which means overhauling their procurement functions and establishing a general counsel for the first time, perhaps, and core business functions. On top of that agenda, we're saying we have a sustainability agenda, an ESG set of priorities. You double click on that and you have climate change and DEI and health and safety and employee engagement and so on. And so when we talk about the difficulty of the measurement, there's a little bit of, hey, these are not companies that are equipped to do an in-depth carbon emissions measurement exercise. We signed on to PCAF last week and made that announcement, and I can link that to why that's part of the solution to this challenge. We assume that a majority of the companies that we invest in are not in a position to do their bottoms-up carbon footprint.
And let me stop you there first, but just to ask the question, and do they necessarily buy into it? Because there are, some jurisdictions or some verticals where they're all in, and then others where, talking about Texas, I've heard people say you can't even talk about this in some parts of Texas and with certain people. So I wanted to stop you there to first even talk about it from a cultural perspective.
Yeah, it's I think on the good news front, there's no question about the direction of travel. Regulatory regimes, not just in the US or in Canada and Europe, in Asia as well, are moving in a certain direction towards carbon accounting. You can argue whether this is done for the value aspect, meaning it's critical to business and therefore it's an important thing to know about, versus values, because we're trying to avoid catastrophic environmental and social impacts from accelerated climate change. but the direction of travel is clear. So then the task for us becomes, how do we frame the overall objective and calibrate it to different audiences? You can find, a CEO based in Texas who may be quite tuned into the local political conversation, but they still want to go IPO in a few years. And we can say, well, if you want to go IPO in a few years, the SEC is going to require that you actually report your scope 1 and 2 emissions, and if material, scope 3. And so it sort of becomes, you don't have to be a believer, but this is sort of the new rules of the game. And we'd rather you be in a position to actually, obviously, manage risk, regulatory risk, but then also to my colleague's point, capture opportunities. That's how you sort of figure out how to calibrate the message to the audience a bit more. But you don't really have what I call, hardcore holdouts who say, no interest, not doing this. And it's up to us, I think, to guide different companies along that path based on where they're starting.
Okay, and you spoke about PICA, and for our audience, that is the Partnership for Carbon Accounting Financials, which Aries has just joined. Can you tell us a little bit about why and what the goal is?
PCAF is one example of many, which is, our economy trying to play catch up with, our goals. Our eyes are bigger than our stomachs, whatever the sequence is. So we want net zero. Where's all the frameworks and the standards to actually implement that in a consistent, coherent, non-greenwashed way? PCAF is one because they recognize that most companies don't actually have a carbon footprint. And to take the time to have each one of those companies collect their utility bills, figure out what their fleet has done, all these different measurements that are quite technically demanding, PCAF has said, in the meantime, we have a way for you to estimate what your footprint might be, and here's the consistent principles you can use to actually do that. So for us, a platform in which, my assumption is a majority of our assets do not have a bottoms-up footprint, PCAF enables us to do the estimate as a starting point. And then it also has basically a data quality rating to say, the lowest data quality is an estimate based on your revenue and your sector, more or less. Pretty crude. But over time, as you replace that with a real bottoms-up footprint, the data quality gets higher. And what you're going to see across the financial industry is each institution trying to guide their portfolio from lower quality levels to higher quality levels, so we can actually get our arms wrapped around what is the actual footprint and how can we measure our reductions.
And just from a timing perspective, it's a lot of work and it's a big push. Do you see, given when you look out over the horizon and all the different assets that you touch, that that 2050 is a reasonable goal? Do you see yourself, Aries being able to get there?
It's a funny topic and a funny question, because there was a chapter of this story in our industry, which is that everyone said 2050, sure, sounds good, we're committing, because it was really hard, it was too abstract.
Yes.
And then there was a bit of blowback to say, what is the meaning of a 2050 goal if you don't have a 2030 goal, an interim target? So I guess my response is, we don't put a ton of weight in 2050 as a goal, because it really didn't demand that much of a leap of faith for people, because they assumed that by then the economy overall is going to be largely decarbonized. So yes, we think it's reasonable if the rest of the economy goes with it and policy is in place, and a lot of ifs. I think the current mood that we're feeling is that we'd rather center the conversation around more tangibly what's in front of us. How can we advance this work in our strategies? How can we increase measurement, transparency, reporting? How can we advance the frameworks to enable commitments that are more substantive? In 2050 is less interesting to us. We found that our stakeholders, our LPs, our investors, our shareholders, our employees, they tend to be a bit more focused on the near-term action than necessarily the long-term.
Okay. Laura, I want to ask you, as we're listening to this conversation, clearly there's a lot of complexity involved. And I think that's one of the reasons that people are tuned in today, is to kind of get a sense of, either how do you start this journey, or, you're in the middle of trying to bring together a lot of data and make sure that you're keeping up with your disclosures. What advice do you have for clients who are either making the commitment or are looking to achieve net zero? What are some of the key things that you would be advising them right now?
this is why we built the software at the end of the day, because I realized the clients were asking the same thing. Everyone from, we work with the YMCA all the way up to some of the biggest banks in Canada and the US, and they're asking the same thing. So it's like, we can surface best practice and we can say, look at this example from an oil and gas company who's figured out how to link executive compensation to climate goals. You can learn from that. And, thinking about what you were saying, Adam, this is a financial risk. And I think we're starting to see that question, like who's regulating this? The financial regulators. And Mark Harney, that's a Canadian success story as far as when he came his place at the Financial Stability Board, when he was saying, this is the tragedy of the investment horizon. So we're having investors like Adam asking for these questions, having financiers like Jonathan asking for innovative ways to think about this. It's the same process. So the TCFD is a very helpful framework. Governance, risk management, strategy, metrics, and targets. There's a number of questions that we can ask to say, where do we fit in with this? And sometimes actually knowing the exact numbers, that's why I'm a fan of PCAF, because the exact numbers aren't actually as important as direction of travel. And we spent a lot of time trying to get the numbers exactly right. So I tell our clients, let's think about what your business is. How does it interact with climate? And how do you think about shoring up sustainability as we move through the transformation? When you think about it like that, it's a lot easier, I think, for business leaders to think about this. And we're surfacing those best practices across various sectors, across the world, aligned with the TCFD framework, which, by the way, Adam, you were saying, it's now, writing on the wall. 85% of global GDP has had a government say this will be required. So even though we hear, squeaks from certain states and different places, it's moving. It's already required in the UK. It's required in New Zealand. It will be required in the US. And it's time to get your story right and understand how you're going to manage this risk, because access to capital is now squarely at risk if you don't understand your story.
Well put.
Go ahead. Oh, well, sorry. Anybody can jump in at any time, by the way. And let me just remind the audience, if you have any questions, please submit them. And, I'm happy to surface them with our panelists here. They're a great resource, as you can see. So, use this opportunity. And just to follow up, Laura, what you were saying, when you say you're talking with your clients to kind of surface like the whole, that holistic view around sustainability, can you give us a kind of a concrete example of what that may look like?
My favorite, it's like a meme here at Manifest Climate that it starts with governance, but it starts with governance. Who's in charge? And if you say a new grad in your sustainability department, it's not good enough. So basically you're asking, does your board talk about this? How are they informed? Who on the senior executive team actually has climate in their peer view? Those two questions get the ball moving so much quicker, in my opinion, than, do you know your carbon emissions? Because then you're going to empower the right decision makers to think within the organization, what is our climate story? And, I always say it's moving away from being a brochure to core financial reporting. So think about how this is, we're talking about change management for a changing climate. And I really think the place to start is governance. Then you think about, how are you managing risk right now? How does climate come into that? Then you think about your strategy. What does the future look like? And then you get to metrics and targets, right? Which is, only one of the 11 TCFD recommendations is about what are your carbon emissions. The other 10 are all very much more process built around governance and strategy. So I think it's just getting to know that and not being scared, like I don't understand exactly where all my emissions are. You say, how do you think about strategic business issues? Do the same with climate.
I think that's a great point. And I will just add, one of the reasons we invited Adam onto this panel is because he actually reports directly to the CEO of Aries, which is actually quite unique, I think, and really demonstrates and has a team that he's continuing to build out throughout the organization, and really shows, I think, an organization that has understood the governance side of things, when ESG is either an add-on or, reports into communications, or is one person in a very, very large organization. I think that speaks volumes. And editorializing here, but that's just from my perspective, is it really speaks to the commitment of the organization and how they're thinking about that. So I now want to kind of move on to and kind of riff a little bit off what you were saying, Laura, in another way. And I'll start with Jonathan here. And that is, you talked about how how you want to help your clients in terms of revenue opportunities. And I think this is really interesting because part of the challenge around carbon and ESG writ large is what's the connection to value creation? And I think a lot of organizations kind of grapple with that. So maybe if you could speak to us a little bit about how you're thinking about how this can be accretive to a corporate bottom line.
Yeah, and look, it obviously depends on the industry that you're in. I feel like so many things in ESG and climate are in that category of, oh, it's not material until it's completely material and is the entire thing, at which point it's obvious that that's a financial materiality. But I'll pick on just a simple example. Carbon intensity of certain products has real value, right? If you're in the hydrogen space, hydrogen is an atom, or it's two atoms joined together with a bond, but fundamentally, it is elementally identical if you have hydrogen that was created through one process or another. But because of the regulations we have in different parts of the world, because of the expectations, even down to consumers, it is different depending on how you got it, in terms of what it drives in terms of business value. We see the same thing on renewable fuels. We see the same thing on even battery metals, where people are asking questions around, how did you get the ingredients that went into this thing that's supposed to be driving positive impact? And when you get to that point where that can be your business model, that you can take the exact same thing that somebody else can produce, and you can produce it in a way that generates less externalities in the world, and you can get paid for it, that's a business opportunity. I think, for all that there was a lot of uncertainty, people were doing a lot of will they, won't they, the IRA in the United States, the Inflation Reduction Act, was a catalytic moment where people are still trying to figure out, do I have a business suddenly? Because other people might have a business that's radically more profitable if they are able to access investment tax credits, pricing benefits or subsidies for creating the exact same thing you were creating, but with a lower carbon footprint. But also people that suddenly have a business that had a well-developed science project that they've been working on that had a real solution, but that just couldn't get paid or couldn't create the returns expectation that investors had, that suddenly does. And we see for clients a massive opportunity to invest, to look at their businesses and to ask the question of, where do I today create carbon that can be a business advantage? I think the world in which we are going to have true pull through, where everyone cares so much about their individual climate footprint that they're going to say, hey, I'll pay incrementally more for low carbon Cheerios and for regular Cheerios, and that'll drive regenerative farming. I don't think we're going to get to that land anytime soon. But where these policy drivers come in, where their abilities to get paid, you can have real choices in your business. And I'll pick on just for a minute the kind of renewable fuel world. There are a lot of businesses that have been collecting fats, oils, and greases for years that were profitable, that were really attractive businesses, that Adam Aries may have invested or is still invested in a bunch of them, that have realized that the end product of what do you do after you collect it, you're not a waste collection mechanism, you're actually a feedstock aggregator. That because of the ability to create a lower carbon intensity fuel, some of which can be just dropped in and used today, that's more profitable than the underpinning business that you used to have. And that really is a way that you can transform your business. It seems silly because, again, after that happens, it's just business. It's not, hey, I understand my climate risks and opportunities. It's just, taking advantage of the opportunities you have and monetizing them. But understanding all these pieces and where they can go in a rapidly changing policy environment is something that, if you're running your business effectively, you should be doing. Because you don't know unless you actually can answer affirmatively. I have a view and an outlook on where policy is going, how I benefit and where I might not, and how I can create business lines around it. There are certainly some businesses that might feel far insulated, but a lot of businesses actually are much closer on the exposure than they might initially think.
So Adam, when, from Aries' point of view, when you're looking at acquisitions or making investments, I'm sure there's the risk lens that you put on when you're looking at firms, but how is Ares thinking about the opportunities and making this part of the value creation process?
Yeah, it's a very top of mind question for us. I mean, there's the obvious one, which is that there's a huge investment opportunity overall in climate solutions and climate infrastructure. And we have a strategy that's dedicated to that. If I think about the more broad-based, diffuse approach on value creation from climate, yeah, it's pretty simple. This is not just about wanting to save the world. This is about running businesses better. So as we engage with CEOs and management teams on how do we tailor the overall sort of abstract climate change challenge to your business, we talk about costs, and it's pretty simple. You lower your energy consumption, you lower your energy cost. If you change to an all-electric fleet, you're not paying for fuel anymore. For human capital intensive industries, we know that this is a generation coming up that finds this topic very important. So if you want to reduce the cost tied to employee turnover, increase your engagement, you have to have an approach here. And then finally on the physical risk point that Laura brought up, there's pretty stark examples almost every month in the paper now across the world about how extreme weather events are causing enormous damage to businesses. So that's a pretty clear conversation. On the revenue side, agree with Jonathan, it's tailored to the industry. But we've witnessed a number of companies that just 2 years ago were saying, we don't really have a position on this. It's not that relevant to us. And then once their key customers started to say, you must do this if you want to do business with us, their tune changed overnight. And so back to the pressure points, as regulators, as customers, as competitors accelerate into this space, of course, executives are saying, oh, wow, I need to retain customers, get new customers. And then once you kind of catch them, you begin to think more creatively about what new products and services could we produce that would meet this emerging need. So it's a menu, but I found that there's always something for every company.
We have a bunch of questions that have come in from our audience, which is great. I'm going to start with one of the first that's come in, and it's actually from a PR agency. And I'll direct this one at Laura. And the question is, how can we help our clients to promote their newer climate efforts without seeming like they're jumping on a bandwagon or greenwashing?
Love it. We're actually toying with the product feature, greenwash alert. Because part of what we do is kind of say, what are you saying? What are you doing? What's the gap? Right. And the say-do gap and this like long-term versus short-term commitments is very challenging. So I think Adam hit on something that I want to emphasize, which is like, what are you doing now? And it doesn't have to be that crazy. It just has to be something, because we see a lot of these like long-term ambitions and it's like, it always seems impossible until it's done. We love that. And it's saying like, we know this isn't good enough. Let's be honest. No one's doing something that's good enough. No one, but it's a start, and it's a serious start, and we're putting serious effort behind it. So I think like that a level of transparency and honesty needs to happen. We have a long-term ambition and we have short-term actions. The short-term actions are fully inadequate. Like we actually need to say that, but it's the best we can do right now. And we're going to actually prioritize it. And we have, because we have this person in charge and we're monitoring their compensation, linking it to the targets. I think that is something that really gets people excited. One of our asset manager clients actually says they're seeing alpha now from just good management disclosure. Yeah. So I think, we need to it's okay that we don't have all the answers, but we have to ask. And the thing that, I think my career would be a success if we empower people to ask better questions, because I think it's about asking better questions and being okay with ambiguity in this time, but saying like, let's just ask the questions and be moving along that role. So the other thing that agencies have to do is say, this isn't like PR is telling the story, but then where is the backup at an actual management level, and actually alignment with, and I'm going to go back to the TCFD, but alignment with standards like the TCFD, looking at credible benchmarks and saying, how do we make sure we're actually telling the story in a credible way, aligned with best practices, and actually engaging the right people within the organization. Those are some easy things to do to make sure you're avoiding greenwashing.
Yeah, no, I think that's very smart. I mean, two things for sure is, we used to say during my time in politics, comms doesn't drive policy, policy drives comms. And secondly, it's really about intention. And so many organizations are afraid about not being perfect, we're not going to say anything until it's absolutely perfect. And I think intention is far more important, and showing that, you're committed to the right things. And you may not have all your T's crossed and I's dotted, but that's not the point. They don't, I've heard many institutional investors saying, we're not really interested in, your pretty pictures. We'd rather see what you're actually doing, and it doesn't have to be perfect right now. So absolutely. We have a couple of questions here, quite interesting. Jonathan, I'm going to start with you. And they're kind of related. How does, you mentioned the American Inflation Reduction Act and the clean fuels incentives. This is a question around just, as the bank works in several different jurisdictions, how does Canada compete against something like that? And, we are seeing different policy approaches in Canada and the US, some carrots in the US with the IRA, and some sticks in Canada with the carbon tax. We love our taxes in Canada. So what are your comments in terms of the differences in policy and how Canada can compete?
So I think we need both is generally the answer. And the reason that the Inflation Reduction Act in the United States is structured the way it is, and we were in Climate Week chatting with some people from the State Department, and it's very simple. There's no value on a price in carbon in the United States and the political environment that exists there. One of the challenges we have on carbon pricing in Canada is that to make investments and to get away from the idea that it's just a tax, but is also a revenue mechanism, you need the expectation that you're going to get paid in the future. That if you're going to put an investment in the ground that requires 15 years of payback and then a whole bunch of gravy at the end, that the price on carbon has to be there in a persistent way to justify that investment. In the United States, I think it's pretty trivial to say, and Adam, I feel like I'm doing the armchair politics from up here, but like zero probability of continuation through change in government, right? Like transition of powers, I think would basically be day one, scratch it out and away you go. It's very different if you do an investment tax credit. You're giving someone something that they're entitled to, that they are making those investments and making those decisions on that basis. It's really a contract that if you want to tear it up, there's consequences, there's faith in government, and there are real expectations that that's just a bad business move for the government to take. I think we can get there with a carbon price and one of the things that we're really excited around is the potential for a contract for differences with the government, a backstop that allows investors, people that are driving that forward, to really make those investments knowing that they will get paid, that that market is being assured to some level, because otherwise we don't create the solution sets, right? The best thing about the clean fuel regulation as proposed and as it's coming in, that really does build on the LCFS structure, the low carbon fuel standard in California, is the idea that you tell someone, hey, you need to reduce the carbon intensity of your fuels by 10%. But you tell anyone that's creating solutions that every percentage point that you drive beyond that 10%, you're going to get paid for. And so if someone creates a zero carbon fuel, they're experiencing a carbon price that affects the whole basket, but getting paid against something that you can levy against people on a 10% basis. You're essentially levering up that price by 10 times. You're actually saying, you know what? I'm going to charge you a carbon price that really reflects a tenth of the price you experience. And that's why, a target or a penalty price in the $300 range might seem massive for a carbon price, but it creates a functional price on carbon for investments that you can invest behind while creating a compliance cost that's a lot lower. And so that's a very long way of saying, I am actually bullish on carbon pricing structures. I think there are ways to make them carrots. Part of it is still getting to the point that it creates confidence for investors and a level of certainty that allows real dollars to be deployed versus giving people an ability to say, look, if all it is a cost, if I can just wait and maybe it goes away, it's really hard to justify an investment even on improvements within current operations, except for things that really clear a high return hurdle near term.
But do you see indication, at least here in Canada, that we're going to get to the carrot stage and we're going to get that backstop we need?
Yeah, it was announced as part of the budget that there will be a contract for difference mechanism. I think the real question is how and where, and what does it look like, and does it give us the certainty that allows us to finance projects and finance businesses on the back of it? I am pretty bullish on where we are going with that. I also do think that the more of these mechanisms that get tied to a global stage with border carbon tax adjustments, with market opportunities centering around, well-mature markets like the EU ETS, that the incentives to tear up policies or to say, hey, we're going to take that away, go away. We have all sorts of policies that, people rely on that do not have a contracted backstop because they exist in a global market that says, hey, why would I take something that functionally leaves me with a tariff because I'd be doing something anti-competitive, or that exposes my industry to an uncompetitive environment globally? And I think that the second we realize that a lot of these climate policies can be sources of competitive advantage, not just a tax, we get into a point where why would anyone tear it up on either side of the aisle?
Can I have one point?
Chime in? Yeah,
because I worked a lot on Ontario's cap and trade system, and I made the arguments that Jonathan was making around it's hard to rip that up. It happened, right? They paid. And so what we need to do is that to never be acceptable from a business perspective again, because we need the market participants to be begging for the policy. And I think we've been doing it the wrong way and saying we're waiting for policy. So our message is if you wait for policy, you're going to be too late, because this is an industrial revolution. And we need to actually enable decision makers to understand the risk. So I think it's really about understanding the risk in the system so that decision makers, that's why I focus my focus totally on corporate decision makers rather than policy makers after that event in 2018, because it's these corporate decision makers need to understand what is at stake here. And if they do, our hope is they're going to be begging for that policy that we know we sorely need. So I think Jonathan totally agree with that, but it needs to go faster. And we can't wait for governments, I don't think, to take the lead on this. They need to be empowered by the corporate decision makers to do so.
Adam, do you have any thoughts on that, government versus corporate decision makers, and how Aries thinks about this?
It's touchy waters to dip your toe into. And so I'll just say that, in the US today, there's a very vigorous debate about the role of business and investors compared to government. And some states that are saying this is, businesses and investors should have no role in this conversation whatsoever. It's for policy and government entities to take care of. But the obvious retort to that is well, how well is that functioning? And is there not self-interest for investors and businesses to actually address these issues themselves? So without getting to specifics and naming names, I'll say that's the current state of affairs.
That's very diplomatic of you.
I wanted to be an ambassador. I didn't mention that in my bio, but in college, I wanted to be an ambassador. So.
Well done, well done. Okay, a couple of other things I wanted to touch on. I mean, we're already talking about the complexity of carbon and how we're going to be managing that. So I thought I'd just throw something else into the kitchen sink with you with that, and that is something I personally care about and I'm very interested in, and that is how we're going to be accounting for biodiversity and the environment. There is a new framework, yet another one coming down the pipeline called the Task Force for Nature-Related Financial Disclosures. I haven't seen much about this really in Canada, but it's definitely getting a lot of airtime in Europe in particular, and there's a lot of activity there. And I'd love to get from each of you your point of view on what companies need to be thinking about to prepare for this. Laura, maybe I'll start with you on that one.
Sure. TNFD is really mimicking the TCFD. There's a reason they sound so similar. They're actually using the same framework. And so it's a really interesting approach. It's how are we taking previous externalities and saying these are not actually externalities. These should be thinking as core business functions. We just haven't done a good job up until now about understanding that nature and biodiversity is actually core to everything working. So I think, we're going to see an evolution of the TCFD framework to include more things, but hopefully it won't create an extra burden. It will just be building on the way that we integrate more into our risk management functions. So the TNFD folks, we were just in the UK talking to them, they're saying that it's by design, that it's really reflective of the TCFD. So if you really understand how do we deal with governance, risk management, strategy, metrics, and targets. The idea is we can continue to layering on other business risks and opportunities that traditionally didn't fall under those categories and put them in. So quite bullish about like bringing more into that. But for me, it's not something other than climate-related financial disclosures. It's just another way of thinking about these things that are so core to our business that we often don't integrate into core business functions.
Jonathan, is this on the radar yet with your clients and in corporate Canada, would you say?
So I think two answers. Generally, no, right? Like most corporations, for very reasonable reasons, just take an affirmative answer and say like, well, I don't think I touch biodiversity, right? I don't see how it touches my business. If I make widgets, that seems pretty straightforward. I think a few places though where it falls into the place of, once it's material, it's obviously material. I don't think a single agronomist would say that biodiversity is unrelated to agriculture, right? That it's one of the key questions you ask when you talk about the value of your land, the value of what you've got access to. And the second you have a monoculture crop that, becomes susceptible to a new disease or a new parasite, you realize how much biodiversity and, nature-related financial disclosures are important to your business. I think though, I would go back to the what should a corporation think about this? And I think the constant answer for all of these areas is that the worst answer when an investor asks you a question about something like this is, I don't know. You can say, I don't think about it much, and here's why. Here are my exposures. I know roughly that this is de minimis and that I'm tangentially exposed. I think nobody's expecting that everyone in France should have said, well, did you know that I'm indirectly touched by preserving fish life in rivers, and that if it gets hot enough, they're going to turn off the power and my power bill is going to go through the roof. Like, nobody's expecting you to know that, but being able to say, look, I know where my inputs come from, and I know whether or not they're affected by biodiversity questions, and whether or not there's a question on the resilience of those spaces. And I know where my customers are and that they're similarly not impacted. And this is why I think I'm in a zone that is in the middle of the sandbox and not needing to worry. That's a good answer to nearly any question, whether it's TNFD, TCFD, ESG. The ability to have an answer that says, I know why I don't need to care about this, rather than just saying, yeah, I saw it in an email newsletter. I don't know. Why don't you tell me? The second that conversation goes, it's not as fun of a conversation with an investor who is hoping to get confidence from that conversation rather than uncertainty and an educational moment.
Yeah, no, a good point. So we have just a little, maybe a minute and a half left, and I'd love to just go around the panel here and just kind of address kind of your parting thoughts on the future of net zero. There's been lots of hash in the media of late around, the future of our carbon objectives. Whether we're talking about greenwashing, whether we're talking about Ukraine and what that means for the future of getting off of fossil fuels. But so some critics may be out there saying that, we need to put this aside and focus on other things. Adam, maybe starting with you, what do you see as in terms of the future of net zero?
I'm optimistic. There have been naysayers for the last 5, 10, 15 years that have found a moment and said, this is the end of this body of work. And they've been proven wrong at each point, most recent being the beginning of the pandemic. That's a pretty severe economic shock. So people were saying, who's going to care about sustainability, climate, DEI, whatever else? And we've all witnessed what's happened over the last couple of years. I think that if we take the long view and the high level altitude view, these big gears of the system are moving in this direction. So yes, of course, you'd expect there to be blips, political blips, administrations changing, they have different views on the topic. But I think enough gears are now clicking together that things are moving in this way. And, enough drivers that create self-interested action on it are in place. So I'm optimistic.
Laura, I'm going to guess it's like, this is, we have no choice, but I'm going to over to you.
It's not a drill. It's not a drill. We are in climate crisis, but I've been saying that my whole life. And Adam, I can say in the last 3 years, people actually listen. There's more people up on the top bailing, and I have never felt more optimistic that we're actually going to be able to solve this problem. And it always seems impossible till it's done. So I just encourage everyone to understand their story and understand that the train is moving, as Adam said, and it's an opportunity just as much as it's a risk.
Jonathan, the last word goes to you.
Yeah, I think I go back to a common refrain we have in our team, which is it's about the and that I think what has shifted in the last few years is there is a belief that it's like, look, someone's going to figure out a solar panel that fixes this. You know, it'll be a negative cost solar panel. We'll build them on top of everything and problem goes away. Or, you know, we'll just electrify everything, plug it all into the wall, green electricity, we're good. And I think the realization that decarbonization happens everywhere, that it's in every business, that it's a business opportunity in every, you know, industry itself, has helped get to what we really need, which is, you know, I used to be a physicist, the area under the curve is what is important. If we say, are you doing something that contributes to a net zero 2050 today? Nearly everyone's answer should be no, because, you know, at most assets will need to be recycled before 2050. The question, though, of what are you doing to make it so that the challenge we have in 2050 is not, you know, bailing out from the 34th floor as the water level's risen, but is actually driving that last hard work of the last bit of carbon that we can't abate out and removing from the air everything that's left. You know, that takes doing a lot right now. And I think it's really heartening to see that it isn't just people pointing over there and saying, I'm glad someone else is thinking about it, but I have no idea how I can impact it, and that it is integrating into more businesses.
Great. Well, thank you so much. And with that, I'm going to hand it over to Joe.
Thanks so much, Andrea. Laura, Jonathan, and Adam, thank you so much for taking the time and investing it with the Canadian Club today. While you've each clearly had a unique journey, your own unique journey to find your passion for climate and net zero, your shared expertise and enthusiasm for making a real difference is, frankly, it's both impressive as well as inspiring. Andrea, as always, thank you for your expert guidance of our conversation today. Canadian Club's vision is to be the podium of choice for relevant and provocative conversations, connecting the business community and promoting an inclusive and prosperous Canada. We aim to achieve this vision at every event, and certainly today was no exception. Thank you so much to our audience, our members, and our guests for being part of it. Thank you to all of you for spending your lunch hour with us today. Stay healthy, stay safe, and we look forward to seeing you soon.